Hi there. Welcome to Week 8 lecture. This week, we will consider consolidated statement of financial position with special reference to IFRS 3 and IFRS 10. My name is Iyo Geho. At the end of this lecture, you should be able to understand the following. What is consolidated financial statements? We will review some key definitions, exemptions from preparation of group accounts, the concept of control. Then we will look at the group financial statement or the group statement of financial position as at the date of acquisition. We will consider how to calculate goodwill arising on consolidation. Then we'll look at the concept of post-acquisition and pre-acquisition profits of a subsidiary. In most cases, only part of the subsidiary is acquired by the parent, so we will look at partly owned subsidiaries, and then we'll conclude by looking at intra-group balances as well as unrealized profits. Firstly, IFRS 10 defines consolidated financial statements as the financial statements of a group, presented as those of a single economic entity. The standard takes the substance over form principle. That means that the parent company as well as the subsidiaries are treated as if they are a single economic entity. We shall look at the meaning of this concept later. A group consists of a parent company together with one or more subsidiaries company. These subsidiaries are controlled by the parent. Because of this, the shareholders of that parent company have an indirect interest in the net assets as well as the profit or losses of the company's subsidiaries. Therefore, the parents are required to prepare and present a set of accounts for the group as a whole. First, let us look at some key definitions. A group is defined as a parent and its subsidiaries. A parent, therefore, is an entity that controls one or more subsidiaries or entities. A subsidiary is an entity that is controlled by another entity. So what is control then? Well, a control exists when the investor is exposed to variable returns from its involvement with the investee and has the ability to affect those returns through its power over the investee. The idea of variable returns means that it has the power or the exposure to the profitability or otherwise or the loss of the investee company, and also has the power. Whether or not he exercises that power is a different matter, but the power exists to obviously control the investor's returns. Now, when a group exists, as I said earlier, a group statement of financial position is required to be prepared. However, there are certain exemptions or circumstances in which the parent may not be required to prepare group accounts. And these are broken down into three circumstances. The first is where the parent itself is wholly owned subsidiary. So in this case, the parent owns 100% of another company, and that company also owns 100% of a third company. So that company in the middle does not need to prepare group accounts because it itself is wholly owned. Or perhaps it is partially owned, but there is no objection from those other members who are non-controlling shareholders. The second exemption is this: the parent shares are not publicly traded. So if they are not publicly traded, they don't have to prepare consolidated accounts. And thirdly, the parent's ultimate parent company present group accounts that comply with international standards. In the absence of those exceptions just stated, a parent must prepare group accounts. Now let us again consider further the issue of control. As I said before, control is important. An investor company has got control over an investee if it has the power to direct the investee's activities. The sort of rights that may give an investor such power would be voting rights, or the right to appoint or remove members of the investee's key management personnel, the right to direct the investee or enter into transactions for the investor's benefit, and any contractual rights. In most straightforward cases, if you've got over 50% of the investee's ordinary share, you are presumed to have control. And for your exam purposes, we will focus on this straightforward case. So you will have to look at the percentage of ownership in the investee's ordinary shares. So, now that we have looked at the definitions, let's begin by looking at some simple measure for preparing consolidated accounts. The first area we'll look at is the date at which control was acquired by the investor. When control is acquired, then consolidated account is prepared simply by adding together on a line-by-line basis the individual statements of financial position of all the companies in the group. The process of adding together line by line the individual assets, liabilities of the subsidiary as well as the parent is known as consolidation. So items which appear as asset in the financial statements of one group company and as liability in the financial statements of another will be cancelled out. Now this is simply because they are referred to as a single economic entity. We will emphasize this later. As a single economic entity, it is not possible for you to sell to yourself, buy from yourself, become your own debtor or creditor. So when there are debtors and creditors or receivables and payables, this will have to be cancelled out when group account is prepared. We will see an example of that in a minute. But most especially, the parent may have paid something to acquire the shares in the subsidiary, and that payment is shown in the parent's books as investment in subsidiary. The cost of investment will not be added together. Instead, it is cancelled out with the subsidiary's share capital and reserves at the date of acquisitions. Adjustments for partly owned subsidiaries are a little more detailed. We'll consider that later. Here is an example of how it works. First example, we have a statement of financial position on the date of acquisition. On 31st May 2019, A Limited pays $35,000 to acquire all of the shares of B Limited. The statements of financial position of the companies immediately after these transactions are as follows. You will notice that A Limited has investment in B Limited of 35. And if you look down at the equity of B Limited, it has ordinary share capital of 30 and retained earnings of 5, giving a total of 35. Therefore, in our consolidation, we will add together items line by line. For example, property, plant, and equipment will become 227, but the investment in B of 35 will cancel out, current assets will be added together such that we have 121,000. The ordinary share capital will be only that of A Limited, which is 250,000. And for simplicity at this present moment, the retained earnings will be only that of A Limited, 58,000. The current liabilities will be added together to make it 40,000. The answer is presented as follows. As you can see from this solution, you will notice that the 35,000, this investment of 35,000, cancels out with the 30,000 ordinary share and retained earnings, both of which represent the net assets of B Limited at the date of acquisition. This is a simple process of consolidation, simply by adding together line by line the assets and liabilities and the items of debtors and creditors, or in this case, the investments in B Limited, that is in the books of A Limited, is cancelled out with the ordinary share capital and retained earnings in B Limited. And as you can see, the third column in this solution group does add up. So the total asset there is 348,000 compared to total equity and liabilities of 348,000. In this simplistic term, that is what consolidation means. Of course, that was quite simple. Simple in the sense that the 35,000 was exactly the value of the ordinary share capital and reserves of B Limited at the date of acquisition. But in real life, the parent may have paid more or less. If the parent pays more, we call that goodwill. If the parent pays less, we call that negative goodwill. As we have said in our earlier studies, IFRS 3 deals with the treatment of goodwill or purchase goodwill that arises on consolidation. It requires that goodwill to be calculated as follows. So each of the assets and liabilities of the subsidiary company are to be adjusted to their fair value on the date that the parent acquired the subsidiary shares. If the parent company has paid more than the fair value of the assets and liabilities acquired in subsidiary, the excess payment is referred to as goodwill arising on consolidation. This will be shown as an asset in the consolidated statement of financial position. As we also state, this goodwill is not amortized. It is left at cost, but subject to annual impairment testing in accordance with IAS 36. And therefore, if there is any impairment loss, the goodwill will be written down accordingly. As I said earlier, negative goodwill cannot be shown as an asset. Instead, it is recognized as income and credited to group reserves. A negative goodwill arises when the parent pays less than the fair value of the assets and liabilities of the subsidiary. Here is a typical example that illustrates how to deal with goodwill. On 30th June 2020, C Limited paid £60,000 to acquire all of the shares of D Limited. The statements of financial position of the companies just after these transactions are as follows. So as you can see, there is property, plant and equipment, but of course the investment in D Limited is 60,000. If you look at the equity of D Limited, it is 25,000 ordinary shares and 17,000 retained earnings, giving a total of 42. However, we are told that the fair value of the property, plant and equipment of D Limited on 30th of June is 40,000. Now, if you look at the property, plant and equipment of D Limited at the date of acquisition, you will find that this is 30,000. So therefore, there is an increase in fair value of 10,000. We call this 10,000 fair value adjustment. So what we have is this: ordinary share capital of D Limited of 25,000, retained earnings of 17, plus the fair value adjustment of 10,000, making a total of 52,000. So the net asset of D Limited at the date of acquisition is 52,000. If you deduct 52,000 from the purchase cost of 60, that gives us a goodwill of 8,000. Let us show the solution. You notice there, here, the property, plant and equipment is now 40,000 for B Limited. So if you add 40,000 to 410, that gives a total of 450,000. The investment in D is cancelled out with the ordinary share capital in B Limited, revaluation reserve, which was the increase in the fair value of property, plant and equipment of 10,000, and the retained earnings of 17,000. So that means we are cancelling out 60,000 with 52,000, and that gives us an excess of 8,000, which is the goodwill. And that 8,000 is taken to the group accounts. The other assets and liabilities are added together on a line-by-line basis as usual. Of course, so far, we have looked at scenarios where the acquisition, where the consolidation took place at the date of acquisition. What happens subsequently? In other words, after acquisition. At this point, we need to be aware that the reserves at the date of acquisition are those that represented the fair value at the date of acquisition. So we call this pre-acquisition reserve. Any reserve that the subsidiary makes after the date of acquisition, so any profit or loss after the date, will be referred to as post-acquisition profits, and that only will be added to group reserves. So that is the point made here, that the reserves of a subsidiary will almost certainly change after the date that the parent acquired the subsidiary. When you prepare group accounts in subsequent years, then the changes should be dealt with as follows. You have to split the reserve between pre-acquisition and post-acquisition. So any post-acquisition increase in the reserves of a subsidiary should be added to the group reserves shown in the group statement of financial position. Whereas any post-acquisition decreases, i.e. losses, will be deducted or subtracted from the group reserves. Any impairment loss in relation to the goodwill is also accounted for by deducting it from the group reserve. You deduct it from the figure of goodwill and also from the group reserves. Let's look at an example. On 1st January 2017, E Limited paid 70,000 to acquire all the shares of F Limited. On that day, the retained earnings of F Limited were 14,000, and all of its assets and liabilities were shown in the books at their fair values. The statement of financial position of E Limited and that of F Limited as at 31st of December 2019, 2 years hence, 3 years later, as follows. So you got non-current assets, property, plant, and equipment, and the investment in F of 70,000. Current assets, equity, ordinary shares, retained earnings, and of course liabilities. The note there says the share capital of F has not changed since 1st of January 2017. Goodwill arising on consolidation has suffered an impairment loss of 30% since acquisition. Prepare a consolidated statement of financial position as at 31st December 2019. It becomes necessary here to have a workings, as you will see in the following answer. You will need 3 workings for consolidated statement of financial position. The first working will be that for the calculation of goodwill. The second working would be for group retained earnings. And the third working will be for non-controlling interest. You only require that working if you don't have 100% of the subsidiary. So for now, we've got 100%, and therefore, only 2 workings are needed. Now, going back to the working number 1, the goodwill calculation, always begin with the price paid. Then we take the subsidiary share capital at the date of acquisition, then the reserves or retained earnings at the date of acquisition, and any fair value adjustment. There isn't one here now, but you will find another in the next example. So if we add those 2 together, that gives us 54,000. Deducting 54,000 from 70 gives us the goodwill at the date of acquisition, which is January 2015, of 16,000. The question says 30% of that goodwill is impaired. So we deduct 30% from there, which is 4,800, giving us a balance on the goodwill account of 11,200. As far as the subsidiaries retained or the group retained earnings are concerned, we take the parent's retained earnings at 31st of December 2019 of 393, the subsidiaries retained earnings at 31st of December 2019 of 26,000, less the retained earnings at the date of acquisition, 1st of January 2017 of 14. So which means the subsidiary has earned additional profit of 12,000 since acquisition. So this additional profit of 12,000 is added to the parent's profit of 393,000 to give a total profit of 405,000. Of course, we less the goodwill impairment that we deducted from goodwill. We also deducted from group reserves to give us a group retained earnings of 400,200. Thereafter, all others are simply added together as we've done before. So the property, plant, and equipment is 667, the goodwill as per working one is 11,200, and the current assets 332. Remember, ordinary share capital will be the parents only of 500,000. The retained earnings as per working 2, 402, and the liabilities, the statement of financial position, therefore balances. Now you have tasted group accounts from a very realistic or basic perspective. Now so far, we have been looking at a scenario or scenarios where the parents own 100% of the subsidiary's share capital. Now oftentimes, the parents may not own 100%. As I said earlier, So long as they have more than 50%, they have control. Assuming they have 60%, that gives them control. But we also have non-controlling shareholders who now possess 40%. How do we account for these ones? When this scenario occurs, IFRS 10 requires that the group's statement of financial position should include all of the subsidiaries' net assets, exactly as if the subsidiary were owned 100%. This is very important. So if we own 60%, we do not, I repeat, we do not add the assets and liabilities, 60% of them. We take 100% of all the assets and liabilities as if the subsidiary was wholly owned. However, we will need to show separately, as part of the shareholders or as part of equity, the amount which is attributable to non-controlling shareholders. We call this non-controlling interest. Here's a typical example. The statements of financial position of G Limited and H Limited at 31st March 2020 as follows. The non-current assets, property, plant and equipment is 527 and 39. Investment in H is 48,000. Ordinary share capital and retained earnings. On 1st of April 2018, which is 2 years ago, G Limited had paid 48,000 to acquire 75% of the shares in H Limited. On that date, the retained earnings of H Limited were 10,000, and the fair value of the company's non-current assets was 8,000 more than their book value. So that would make them 47,000, because currently it's 39,000 plus 8,000 is 47. The revaluation has not been reflected in the books of H Limited. H Limited has issued no shares since being acquired by G Limited. Goodwill arising on consolidation has suffered an impairment loss of 40% since acquisition. Prepare a consolidated statement of financial position as at 31st of March 2020. Any depreciation consequences of the fair value adjustments may be ignored. This time, we will need 3 workings, as I said earlier, because we do not own 100%. But you will notice that the assets of the subsidiary company, which is H in this case, the non-current asset of 39 is added as 39. There you go, 39. We are not taking 75%. We add the whole amount plus the fair value adjustment. The current assets for H Limited again was 31. We added the whole of it, not 75%. Please bear this in mind. And the current liabilities, we added the whole of it, again, not 75%. However, in the group accounts, we showed the share capital of the parent, the retained earnings as in working 2. We'll look at that shortly. And there's a separate component here, which we refer to as the non-controlling interest. You have to work this out in working 3. Let us now go through the workings. Working 1 you are familiar with. You take the price paid of 48,000, subsidiaries equity at the date of acquisition, that would be the share capital of 32, the reserves of 10,000 at the date of acquisition, the reserve was 10,000, and the fair value adjustment of 8. When you add all of that together, that gives us 50,000. But we only own 75% of that. So you take 75% of 50,000 to give us 37,500. This is now deducted from the cost of acquisition to give us a goodwill at the date of acquisition of 10,500. Of course, 40% of this goodwill has suffered impairment loss, so we deduct 40%. The final figure for goodwill at the date of consolidation is 6,300. Let's look at working 2. The group retained earnings here. We take the parent's retained earning, the whole of it. We take the subsidiary's retained earning, the whole of it at the year end, less the retained earning at the date of acquisition, which we have used in the goodwill calculation. So that same retained earnings you deduct from here because we have no share of that. We've paid for that. So when you deduct the retained earning at the date of acquisition, that means that the subsidiary has earned extra profit of £12,000 since acquisition. And again, we've only got 75% of that. So you take 75% of 12,000, which is 9,000. So this is our share of the post-acquisition profits, which when added to 148,000 gives us 157,000. Less the goodwill on the payment that you've calculated earlier to give us the group retained earnings as at 31st of March 2020 of 152,800. In working 3, the non-controlling interest is relatively straightforward. What we do here is to take the retained earnings of the subsidiary, the share capital of the subsidiary at the year end, 32,000, the retained earnings of the subsidiary at the year end, 20,000, and of course, the fair value adjustment that we did on the goodwill. You add that up. So this is the total assets, the net assets of the subsidiary as at 31st of March 2020. But the non-controlling interest only have 25% of that. So you calculate 25% of that as 15,500. And so that is now taken to the consolidated statement of financial position. Notice where it goes. Under equity, after adding together all of the total equity. So this is the equity attributable to members of the parent, and that which is attributable to non-controlling interest is shown separately to get a grand total equity. You have now looked into consolidation, albeit the basics of consolidated accounts. Now, if you remember when I started, I said IFRS 10 adopts the substance over form principle, which means that the accounts for the parent and accounts of the subsidiaries are added together and they are treated as if they are a single economic entity. As I said, the implication of this is that they cannot sell to each other. So if A sells to B, A would have the sales value as part of its revenue, and B will have the sales value as part of its cost of sales. Next week, we will look at the preparation of consolidated statement of comprehensive income. Where that happens, we'll remove the sales value from the sales, and we also remove the sales value from the cost of sale, the same amount. That way, we are eliminating intra-company transaction. Now, notice it says that when that sale occurs, it may be that B has not paid for all of the sale item. So let's say there is 10,000 outstanding that has not been paid for yet. So A would have 10,000 as part of its receivables, and B will have 10,000 as part of its payables. Again, you cannot own yourself as a single economic entity, therefore, we remove such transactions. So intra-group balances are cancelled out when preparing group statement of financial position. Now, the areas where such balances may arise is as follows. A group company may lend money to another group company. So the loan will be an asset for the lending company and a liability for the borrowing company. When you prepare group accounts, you cancel out the loan asset and you cancel out the loan liability upon consolidation. The second instance where this might happen is where the one group of company buys goods or services on credit from another group company. The supplier company will have trade receivable and the customer company will have trade payable. Again, we'll cancel the trade receivable out with the trade payable. One group company may also have a current account with another group company. The balance on this account is an asset for one company and a liability for another. Again, when we prepare group accounts, this will be cancelled out. There is also a further aspect to this, especially this arises where one company sells goods to another, but that good still remains in inventory. I'll give you an example. Company A acquires goods for 10,000, then sold it to Company B for 12,000. Now, of course, at the year end, Company B has not sold the good. So from the perspective of the group, the goods are still within the group. However, the asset has increased by 2,000 by virtue of that transaction. So in addition to removing the 12,000 from sales and cost of sales, we also need to remove the 2,000 that is in inventory. We call this unrealized profits. So as you can see from this slide, the assets shown in the financial statements of a group company may include items acquired from another group company at a price in excess of original cost. This profit is unrealized to the extent that the company that receives the good still has it in its inventory, and therefore it must be eliminated when we prepare group accounts. IFRS 10 requires that profits or losses on intra-group transactions must be cancelled out, eliminated in full on consolidation. It does not matter whether we own 100% or that subsidiary is partly owned. If an asset is sold from a parent to subsidiary, then the unrealized profit is in the parent's company's book, and therefore we will deduct that 2,000 directly from group retained earnings. However, if the asset is sold by the subsidiary to the parent, then the unrealized profit is in the subsidiary's profit. So therefore, when we eliminate it, we have to split it. So if this parent has 75% stake in the subsidiary, 75% of that profit will be deducted from group retained earnings. The remaining 25% will be deducted from non-controlling interest. This ends our session. More of this will be demonstrated during the seminar. I hope you have followed through. And by all means, feel free to contact me if you need more clarification or information. I'll see you next during the seminar. Thank you.